Jerome Powell and the Federal Reserve Board ended its policy meeting just last hour. We've been listening to a press conference. The headline here, they kept interest rates on hold, but dropped this key word, patience, from their statement. Instead, they say uncertainties have increased in their words. Most Fed members see at least one rate cut by the end of the year. You know, they're now weighing a host of challenges, though. We've talked about them before. A possible economic slowdown, a trade war with China, and repeated public pressure, we can't forget that, from President Donald Trump. Now, Wall Street have been in what we call a holding pattern. I argue they're almost still there. J. Powell and company, though, may give them a little boost before this trading hour is over. Now, moments ago, Jerome Powell said the Fed's case for lowering rates had gotten stronger, but the Fed still wanted to see more evidence, of course.
Overall, our policy discussions focused on the appropriate response to the uncertain environment. The projections of appropriate policy show that many participants believe that some cut in the federal funds rate will be appropriate in the scenario that they see as most likely. Though some participants wrote down policy cuts and others did not, our deliberations made clear that a number of those who wrote down a flat rate path agree that the case for additional accommodation has strengthened since our May meeting.
Listen, those are key words right there. Accommodation. The case for accommodation may have strengthened. Ben Phillips is the chief investment officer at Eventshares. He's in Los Angeles. I'm a bit confused by the market reaction. This literally means some people were still hoping for a cut today and didn't like the fact that they actually measured. It was pretty measured about what would happen with the cuts later in the year. What do you think?
Well, I think the market's starting to get a little ahead of itself with the Fed, right? I think after the December, where Jay Powell made, I think, a policy error, his first in his chairmanship. So I think the market is now thinking that Trump can be more influential. I don't think that's the case. And we're actually a little skeptical that we're going to see even a July cut here, even though the market was pricing in an 80% chance before the meeting this morning for a July cut.
And that would explain the reaction of the markets right now. You actually don't think they may move in July. We may be looking at something October, November that's more data dependent.
Yeah, that's right. I mean, I think Jay Powell learned his lesson in December. He should have been looking at the data then and seeing that the market was in a volatile period and there was a lot of uncertainty and probably paused in December. So I think he's not going to make the same error of kind of a knee-jerk reaction and make too hasty of a decision to move rates. I think something would really have to be disastrous. We'd have to see, war with Iran or some sort of military escalation with China or a PMI in like the low 40s for June. Something that shows the economy is really slowing and gives the Fed a reason to cut the rates there.
And even with all the trade uncertainty, I remember, look, I was in Mexico a couple of weeks ago. We were talking about, catastrophic tariffs on that country, which would have significantly impacted that cross-border trade.
Yeah, that's right. I mean, the Mexico thing, that was interesting to see tariffs used as a policy tool in that way. It was really focused on immigration, not trade. So that was just fascinating to see that precedent being set. And I think this is almost the beginning of a new era. Regardless of what we see happen in November 2020, we're probably in a situation where we see presidents use more tariffs as a policy tool, which I don't know if that's necessarily good. I don't think it's good for markets.
Well, certainly business has said it's not good. I have to bring up, obviously, the president himself. His words yesterday was, in terms of whether or not Jay Powell would keep his job, was, okay, we'll see what he does today. I'm not sure what he'll think of this today. Jay Powell couldn't have been more clear a few moments ago. He basically said, I have a 4-year term. I intend to serve it. At the end of the day, the Fed thinks they're on solid ground here.
Yeah, I think Jay Powell's a pragmatist, and the Fed is an independent institution. I think he's going to fight to make sure that the Fed remains independent and does not succumb to any political pressure. So I think he's going to be looking at the market, he's going to be looking at the data, and that's our expectations. We see continued, Fed independence and them making decisions based on what the market data is showing them.
Yeah, it's that whole expression, right? Data dependent. I have to say, we've all marveled at how clear Jay Powell is in these press conferences. I mean, we were just listening to it, and he's being ultra clear. We'll see if Donald Trump actually takes him at his word. Ben, thanks so much for wrapping that up for us. Appreciate it.
Thanks, Paula.
Now, central banks, as we were just talking about around the world, are putting out, yes, this great stimulus punch bowl. It's Hawaiian punch, folks. There's no alcohol, although I asked them to have it there. Trying to keep this economic party going. Now, as you've heard, as we were just talking about, the Fed is considering, let's give them 2, okay? 1 and 2 rate cuts before the end of the year. Not to be outdone, this is the European Central Bank. Remember, we heard from Mario Draghi yesterday. He signaled that they could start printing more money. Yes, they could. And it's all these years after that financial crisis, and still, Super Mario is still trying to prove, look, we'll do whatever it takes, right? After that mistake in 2015. Now, the Bank of Japan meets Thursday, not to be outdone here. You know, we could pretty much throw them in the punch bowl. I won't do that, but let's look at this, okay? Heaping portions here. Why? Their massive stimulus program never eased up after the crisis. In fact, the BOJ is expected to signal even more could come in the months ahead. You know, the real debate among economists is the fact that it hasn't worked, so we can talk about that further. Not to be outdone, Britain. What the heck are they dealing with? You know, it's that little B word called Brexit. The Bank of England has signaled that it is sitting on historically low rates and is unlikely to ease, but you know what? We'll give them some punch anyway because they're still in for this whole Brexit saga. Now listen, critics are worried that this entire supply of punch could be at risk. Central bank independence, as we were just talking about with Ben, is under attack, and fiscal policy, and this is the key here. Folks, it's gridlocked. If there is a real crisis, central bankers could be left with few options to fight it. Anthony Chan is the former chief economist at JPMorgan Chase. Mr. Chan, you will forgive our trite little demonstration there of the punch bowl, but I think it does serve you know, a point in terms of what all the central bankers are grappling with. I'm going to get your first take on what just happened with the Fed and Jay Powell.
Well, I think Fed Chair Powell was brilliant because we all know he was under a lot of pressure, political pressure. But at the same time, the markets are channeling Jerry Maguire. They want a path to the next Fed easing and basically got it. He's essentially said the economy is still growing moderately, but at the same time, uncertainty has picked up. And what that translates in Fed's lexicon is that a Fed easing is not too far over the near-term future. And that's, I think, brilliant.
Absolutely. I think as you said it, they got everything they wanted. Is that because we are in an era where the Fed, and he said it over and over again just a few minutes ago, we are data dependent. We look at consumer spending, it's strong. And yet we look at manufacturing and we're kind of concerned. Is that the key thing here?
Well, right now, manufacturing is weak. It's a cyclical sector. It's about 11% of the overall economy. And when that slows down, it tells you that bad things could happen. But remember, the service sector is still going very strong. Consumer spending is still strong. In the second quarter, 4% is almost knocking on the door of the economy. We might get as much as 3.9 or 4% consumer spending growth in real terms in the second quarter. That's not a slowdown. And the labor market is strong. But at the same time, we know that business spending is weaker. All that uncertainty is weighing on the market. And that's why the Federal Reserve is keeping the door open. And more than likely, the next move will be an easing.
The question is when, right? We had just heard perhaps July. Maybe that's on the sidelines.
I think that July is a real possibility because right now the markets are almost pricing in almost 100% probability of the Fed easing in July. And the trade tensions have picked up. There's the political pressure. And they basically have planted the seeds without giving the impression that it's compromising Federal Reserve independence. And that's why I think the statements by Powell were brilliant today.
If we go back over to our punch bowl and all those central banks, you know, my theory is that since that financial crisis happened, these central bankers have all been under a lot of pressure. They have been doing what they can to stimulate the economy. We are now in a very tight band of those interest rates again. Chairman Powell basically said it himself, right? What did he say? He said an ounce of prevention at this point is worth a pound of cure. And why? They don't have very far to move. I mean, does this concern you? You've got fiscal policy nearly dead or gridlocked in the United States, incredibly anemic in places like Europe and Japan. Does that worry you, Anthony?
It worries me a little bit. I was an economist at the Federal Reserve, and back then there was no such thing as quantitative easing when I was at the Federal Reserve in New York or the Federal Reserve in Washington. But today we have quantitative easing. But still, when you look at interest rates, quantitative easing is the only game in town. You have negative interest rates in Europe. You have basically negative interest rates in Japan. And if they cut the deposit rate in Japan, that makes it even more negative. So, again, there's less room. And even here in the United States, your typical Fed easing cycle is almost 5%. There's not enough room in terms of Fed funds rate. So, yes, monetary policy is constrained. And that's why they may be more anxious to be preemptive in nature so that they don't wait too long and they have to do more. And when they have to do more, they don't have enough room. Yes, quantitative easing is there, but it's a tool you don't want to overdo.
In terms of where this is going next, if we do start to see any kind of these trade wars that are very pronounced, because that could still happen. Do you worry that they'll run out of ammunition at the Fed?
Well, I also worry about what it does to the economy. So far, it hasn't hit consumer spending too much. But guess what? If you look at business spending, it is very soft. And why? Because corporations all over the world, with all this uncertainty, they're not sure if they want to invest. And so that is one of the casualties of this trade uncertainty. And we don't have as much ammunition. So yes, I do worry about it a little bit.